I'm Matthew Bird. I'm an independent financial advisor, and I work for a company called Seer Green. We're based just down the road in Newport, but we cover the whole of the UK. And I'm here tonight to talk to you a little bit about long-term investment. Appreciate that we've got a few adept investors in the crowd, but hopefully it'll serve as a decent, refresher for you. So to start us off, 3 steps that you can use to improve your long-term investment success. Okay, so step 1 is to start saving early. So whatever your savings investment goal, the longer the time frame you allow yourself, the more you're going to enhance the power that is compounding. It's often cited as the 8th wonder of the world, and it really does have a hell of an effect if you allow it to work its magic over time. As we can see by this little diagram, this is a hypothetical investment situation in which you're getting 7% annual return, and in this situation, this investor has been investing £1,000 a year that's compounding at a rate of 7%. The difference between the 2 lines is the purple line is starting at the age of 25, and the green line is starting at the age of 35, so no other difference whatsoever. But you can just see the difference at sort of, imagine this is someone's pension, you end up at 65, and the person who started 10 years earlier, so they've only put in an extra 10,000, they've ended up with more than double. And it just boils down to basic maths, really. There's, a lot of you will be familiar with the rule of 72, where you just divide the investment return you're getting by 72, and you'll get the amount of years it takes to double your investment. So with a 7% return, you're looking at doubling your investment every 10 years, which is basically why the person starting later is ending up with half what the person starting 10 years earlier is getting. Interestingly enough, if you started investing at 25 and actually stopped investing that £1,000 a year at 35, you'd still end up with more money than if you invested £1,000 a year every year at the end. So, step 1 is definitely start saving early. Step 2 is know your asset classes and use them appropriately. And here are some stats I've got from the Barclays Equity Gilt Study 2016. So these are real UK investment returns over a 116-year period. So equities have outperformed inflation by an average of 5% a year. Inflation was about 3.8% over the time period. Gilt outperformed inflation by about 1.3% per annum, and cash by a measly 0.8% per annum. And actually, if you look at shorter term figures, the last 10, 20 years, cash has been a minus figure. You would have actually lost money by keeping your money in cash because you'd be getting less than inflation. What I haven't mentioned here is the volatility of these asset classes. Obviously, equities, as many of you will know, are incredibly volatile. And it depends on the investment time frame whether they're going to suit you. If you're saving for something within sort of a 5-year period, they're probably not going to be for you. If your sort of timeline is maybe 5 to 10 years, you're probably going to want a mix of all these assets so that you've got some chance of getting a real return, but hopefully you'll dampen volatility a little bit. But if your timeline's 10 years plus, certainly if it's 20 years plus, you want to be thinking about maybe having most or maybe all of your money in equities to be able to, going back to the graph we saw on the previous slide, you're not going to be able to get that sort of 7, maybe 8% return by investing in gilts or cash. So step 3 is use the most appropriate tax-efficient vehicles for your investment. And a little question here. How can you improve your investment returns by 41.67%? The answer, well, there's a few assumptions here, but if you're a higher rate taxpayer, make a pension contribution. You get 40% tax relief at source. Most people are still basic rate taxpayers when they will draw this money out, as we'll see in a later slide. So it is a realistic assumption. When you withdraw it, you get 25% tax-free. The remainder, tax of 20%, leaves you with a total of 8,500. So if you make a 6,000 contribution, you'll end up with 8,500, which is an uplift of your 41.67%. There's no investment growth at all assumed here. And actually, you could probably enhance this a little bit if it's a salary sacrifice arrangement, because this doesn't factor in national insurance savings either. Obviously, one of the downsides of pensions is that you can't currently access them until you're 55. So obviously, if you're looking to retire earlier than that, maybe it's not a great idea. So as I alluded to earlier, less than 1 in 7 higher rate taxpayers will pay higher rate tax once they've stopped working. So the assumptions made earlier are realistic. And I'd just like to point out as well that the cost to this of the government is humongous. In 2014-15 tax year, the cost of the government of this was £48 billion. And 2/3 of that went to higher and additional rate taxpayers. And I guess there's just a lot of talk at the moment about how long this is going to last. It's a little bit of a low-hanging fruit, I think, for the Chancellor, and there's a lot of speculation as to whether higher rate tax relief on pensions is going to get the axe at some point. So I would certainly encourage anyone here who is a higher rate taxpayer to take full advantage of the current situation while you still can. And this graph here shows you the effect that sort of different rates of tax relief can have on an investment. And this hypothetical situation has assumed an investment return of 5% compounded a year, and then at different rates of tax relief. So the bottom line, the blue line, assumes no tax relief. So this would be the equivalent of holding this investment in an ISA. Then the others are at various rates of tax relief. So you could equate them to a pension, for instance. The black line is where you get basic rate tax relief. The green line is where you're getting higher rate tax relief, and the orange is where you get an additional rate. So, if you are saving long-term for retirement, then pensions are pretty great. As you can see, if you're an additional rate taxpayer, you end up with a hell of a lot more money in the long run just by making a pension contribution rather than putting that money in an ISA. So pros of pensions, as we just alluded to, generous income tax relief on contributions, no capital gains or income tax on investment gains. 25% of it can be taken as a tax-free lump sum. They're incredibly flexible now. Historically, you used to sort of almost, you were forced to buy an annuity when you sort of hit retirement, which put many people off pensions, put me off, in fact. I've only recently, in the last few years, really become more of a pension advocate since the Flexi Access Drawdown rules changed. And an interesting one as well, pensions do not form part of your estate. Under most circumstances, and no inheritance tax will be due. And we're increasingly, with property prices, etc., going higher and higher, we're increasingly running into clients who've got, IHT liabilities, or they're blatantly going to run into them at some point. So as pensions do not form part of this, they can be great in tax planning for that. Cons of pensions, ultimately they are taxed at your prevailing rate of income tax. You cannot access the funds until you're 55 under current legislation, and that will rise steadily. It's going to 57, 58 over time. And there's always that possibility of future government intervention. And, as I mentioned earlier, at some point, higher rate tax relief might be removed. So make good use of it while you can. But I'd say most people do have pensions, and certainly with the advent of auto-enrollment schemes, most people will have pensions. But from what I see, they're vastly underutilised. So they're probably one of the major, one of the best tax-efficient vehicles to use. But there are many others out there, such as ISAs, VCTs, enterprise investment schemes, and seed enterprise investment schemes as well. Haven't really got time tonight to sort of go into depth with all these different schemes. So if you want any further information on that, I've got a couple of colleagues here as well. We'd be more than willing to talk to you about any of these schemes in the break. So just to tell you a little bit about the company itself. We've got 10 people at the company. We've got 75 years of experience between us, specialists in every department, and a couple of them here with me tonight. We're a trusted source of information for the media, so we're quoted quite regularly in the local press. We've been quoted in the international press as well, in the Independent, in the Times. And we're on the radio quite regularly as well. One of our directors has got a regular slot on BBC Radio Wales. Expertise, pension, investments as alluded to. Also do the kind of normal, what you'd expect from an IFE firm, life insurance, mortgages, tax management, etc. We are still independent. We value our independence in an area where we're increasingly seeing a lot of our competitors drop that status and go tied, or what's called restricted whole of market. Restricted whole of market basically means that you do look at kind of whole of market investments, but you tend to use sort of one or two platforms. And the trouble with that is that you can actually save a lot of money by shopping around for different platforms. We've got some decent discounts with some of them, and you can actually, just by shopping around, save 20 to 30 basis points just by using the best platform for the client. So we think independence is, despite the additional compliance that paperwork that we have to fill in, it's definitely worthwhile. Why use an independent financial advisor in the first place for pension investment advice? Well, I found this article. This is an article that Vanguard had written, and they analysed investments that were going in and out of their funds, and they found that because they know whether the sale was advised or not, and the sales that were advised were on average earning 3% more a year than the sales that weren't advised. So how do we add that value? Well, starting at the bottom here, Vanguard thought that a lot of this 3% came from behavioural coaching, and basically that entails essentially when the proverbial's hitting the fan, when the markets are sinking, quite a lot of people, as my colleagues will tell you, the phone starts ringing then. Everyone's worried. They're saying, should we sell now? And, part of our job is to sort of convince them that selling low, buying high and selling low is actually not a very sensible approach, and to stay where they are. And that's where a lot of that performance comes from, actually. It's a funny occupation that we work in, isn't it? The stock market is one of the only sort of markets in the world where, when there's a big sale on, people run out of the shop screaming. So also, as mentioned before, we save money by making their investment as tax efficient as possible, and we add value via our independent status as well. And we are independent. We deal with numerous third-party investment companies, etc. But I'd just like to very briefly touch on one of our centralised investment proposals, which is our model portfolios. So these are 4 portfolios, basically designed to match an individual's attitude to risk, and they basically vary from a 100% equity portfolio to which we call the adventurous portfolio, to a more cautious portfolio, which has got a higher mix of bonds and property and other assets as well, with the objective of lower volatility. We use a blend of passive and actively managed funds, and there's an underlying weighting towards defensive stocks, so low beta funds and companies, because there's a lot of statistical evidence that this strategy outperforms the market over long periods of time with less volatility. And the portfolios have global exposure and wide diversification as well. On the active fund managers front, we only use fund managers that have a long track record of outperforming the market, so typically 15 to 20 years track record. We prefer fund managers who own their own companies, because there's less chance of them index hugging, less fear of losing their jobs, I guess, in the short run. We like to see a low turnover buy and hold approach within these funds. And also, I'd say with the model portfolios themselves, we try and engender a low turnover approach ourselves. Fund switches are probably less than one fund change per annum. I quite frequently come across model portfolios from third parties where they rebalance. We analyse ours quarterly. Everyone seems to do that, but quite often on a quarterly basis, a lot of these model portfolios are switching funds like mad, and you sort of think, well, if they picked the right fund in the first place, would you have to be switching so often? We prefer fund managers who have high percentage of their own wealth invested in their funds, skin in the game, and we only use funds that are competitively priced with transparent charging structures. And that's just a little performance graph, last 5 years versus the WMA stock market global growth total return. So as you can see, we've had a decent outperformance there and less volatility as well, which is pretty much what we're after, really. The geographical breakdown of that, this is the Adventurous, the 100% equity, more or less 100% equity fund, is 45.8% UK equities and then 48% global, overseas. This is the top 10 holdings, so you can really see here the kind of defensive stance showing through. The low beta stocks that I mentioned before. We do have a few small cap funds in the portfolio as well, but obviously they're not showing up in the top 10. To quote Jim Slater, the late great Jim Slater, he once said that elephants, alluding to large cap stocks, that elephants don't gallop. But from some of these stocks, they can trot along nicely, and also they're bloody hard to kill as well. I'd pick one, a pertinent one, Unilever. I was looking at some stats from Unilever the other day. So over a 20-year period, Unilever have managed to offer compounded returns, including dividends reinvested, of 12.6%. So going back to that sort of rule of 72, your money there has doubled every sort of 5.5 years with them. So large cap stocks can move quite nicely as well. These are the total expense ratios of the portfolio, so ranging from 0.61 to 0.76. And yeah, that's everything. So if you've got any questions, please feel free to ask.